What's next for mortgage rates? I think there's a very good chance we see 5.4 to 5.7% mortgage rates in the near future, and in this video I'll explain why. There will be charts, there will be graphics, and there will be speculation. My name is Michael, I'm a real estate agent here in the Dallas area, and my goal is to keep you as informed as possible of what's going on in the real estate market so you can make the best decision possible. If that sounds like something you're into, go ahead and hit the subscribe button, make sure to hit the bell and turn on notifications so you're always the first to know. All right, let's jump in. First of all, the main thing you need to understand about mortgage rates is that the 10-year treasury yield and mortgage rates have moved together since 1971. So if you want to understand where rates are headed, you've got to know, understand, and look at the factors that impact bond yields. You can see that reflected here on this chart. The top line is mortgage rates, the bottom line is 10-year yield, and you can see all the way back to 1971 how they follow each other. Historically, on average, mortgage rates are about 1.7% higher than whatever the 10-year yield is. But in times of volatility like this, they're closer to 2.5% or 3%. But the point is, you can see mortgage rates always follow 10-year yields. So at the end of January, mortgage rates got down as low as 5.99%. Then all through February, they climbed to 7.1%. Why is that? Bond yields shot up. Why did bond yields shoot up? Economic data was holding firm, inflation didn't appear to be coming down as quickly as it needed to, and the big one is unemployment. Unemployment numbers are too low. It looks like the economy is still too strong, so bond yields started rising again. As long as the economy looks strong, 10-year yields remain high, which means mortgage rates remain high. The whole point of raising rates is to slow the economy. It's to make it too expensive for people to borrow money so that they stop spending so much money. That's the whole goal of raising rates. So we got back up to 7.1%, but now just a few weeks later at the end of March, we're down around 6.3%. So what happened? The new variable of a banking crisis. So there's a new belief that this banking crisis is going to tighten credit all around America, which will prohibit the economy from growing at a normal rate. So economic growth slows, unemployment starts to rise, and inflation naturally comes down along with the crisis. Essentially, the credit tightening that will come from the bank collapse of banks not being able to or wanting to lend will take the place of higher interest rates. So if the bank's not lending, we'll do the tightening. There's no need to raise rates anymore. So essentially, we don't need to raise rates anymore because naturally banks are tightening. So March 9th was a big day. That was the day the story broke that Silicon Valley Bank was going under. If you look at this chart, this is the 10-year treasury yield chart. You can very easily spot March 9th. It's the day that things went straight down. So here you can see reflected in the numbers the belief that banks collapsing is going to cause credit tightening. So everything we're basing about mortgage rates is from this chart, the 10-year yield. As we can see, the 10-year yield has been trying to break below this line, which is about 3.36. So around here has been the line in the sand. Every time it gets down here, we see a reaction that's not ready to break, not ready to break. They were climbing, and then we have March 9th banking crisis, and we come straight back trying to break below again. So the markets are telling us they want rates to come down. They're looking for reasons to come down. So each of these is a daily candle. I'll count this one. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, at least 11 tries of trying to get below this line in the sand. So it's very clear that this is where treasuries want to go. What happens when this line breaks? So this banking crisis is actually something that the Federal Reserve needed to push inflation down. So it's likely the 10-year yield goes down from here, which means mortgage rates go down from here. So if this line in the sand finally breaks, where do I think rates are going to go? I think the first stop very easily is going to be right here. This is a number that I would correspond with about a 5.7% interest rate. And if that gives, we're looking down here at a 5.4%. And again, those are give or take, but that's my expectation. The whole point is you either look at this line, you see that the market's trying to break it and you believe that it's gonna break, or you think it's gonna hold and we're gonna continue to climb. For me, this is plenty of evidence that it wants to break below and eventually it's going to. But I'd love to hear what you guys think. Do you think the line is gonna break or you think it's gonna hold? I'd love to hear your thoughts in the comments. One thing we know for sure is when rates got down to 5.99% in January, a lot of demand came back in the market. How do we know this? Because every week in my weekly market update video, we track mortgage purchase applications, which is people applying for mortgage. That's our best indicator of what demand is going to look like 30 to 90 days out. So if you're interested in that, make sure you watch every Monday for my updates. So much demand came in from that January drop in rates that from January to February, prices in Dallas, the city, increased 18%. month over month. So it's very clear when rates get closer to 6%, there is a lot of demand waiting to buy. But also don't miss the time of the year, because if this line in the sand breaks here in April, May, June, then demand is not only increasing because rates are dropping, but also because of the natural increase in seasonal demand of the spring market. And as of now, there are still about 2 million less homes in the US to choose from than there were at the start of the pandemic. So we're in an extremely supply-constrained market. So we have a perfect storm of less supply than ever and the potential for a huge wave of demand to come in from both the spring market as well as lower rates. So if you think housing prices are high now, just wait until that demand comes in and there's still no houses for sale. It's going to be back to multiple offers, bidding wars on everything, and prices are going to go straight up again. So please don't wait to partake in that market, because it will be next to impossible to win a house. By far, your best move is to buy now while things are as slow as they've been for years and you have the opportunity to go and even possibly get a price reduction, get the seller to buy down your interest rate. Like, for the first time in years, you have options. Don't take that for granted. Your best move is to buy now, wait for rates to drop, and just refinance. If you're considering buying a home in the Dallas area, shoot me a call, text, email, or if you'd like to schedule a free consult, whether on video or in person, all of that is in the description. I'd love to get to know you. That's all for this video. If you got any value from it, please give me a thumbs up, and I look forward to seeing you in the next video.